what we've concocted here in the stock market is the greatest asset bubble we've ever seen. And that includes real estate, fixed income across the spectrum, and equities. Never been more inflated. And it's a triumvirate of asset bubbles. If you look at the internals of the market, they're just horrific. There's crashes all over the place. Now, the major averages are very close to an all-time high, 1% of an all-time high. But let's just take a look at Cathie Wood's ARK Investing, the disruptor space. This is the exact kind of thing that I, treat like a pariah when the second derivative of growth and inflation are slowing or about to slow rapidly, which is what my predicate here is in 2022. I almost said 21 because now I'm talking to you now in December of 22, and I hate doing this because only God knows. Anytime you have the hubris and arrogance to think that you know everything, you will be humbled. But so having said that, there are some educated guesses. The weathermen do it all the time. A lot of people are angry with them. I think they do a pretty good job. For some field that predicts the future, that's pretty much they do a pretty good, accurate job. So my predicate is, we're talking to you now December 2022, is that the shock was that the Fed killed the stock market in the first half of this year, 22, and they were not able to consummate on their 3 anticipated rate hikes. And they actually had to go back into a ZIRP policy and a QE mode. That would be my major risk of what would happen in 2022. But back to Cathie Wood for a second. When you are in an economy that's rapidly slowing, economic growth is slowing, and inflation, albeit very high, is still going to be on a rate of change basis decelerating, you want to avoid certain stocks, banks, cyclicals, high beta stocks, low earning stocks, high PE stocks, small cap stocks. And these are the kind of stocks that are in Cathie Wood's ARK Investing. Well, about a week ago, she has 45 stocks. 43 of the 45 were down 20% or more. 2 of them were down 80%. So, when you think about things like that, you say, well, wow, this is a very dangerous sector of the market to be in. I never want to be down 20% in my portfolio. And she's down 20% in 43 out of 45 stocks, according to CNBC's report. So you want to be set up for a more defensive structure. So think about consumer staples, utilities, bond and bond proxies. Why? Because inflation is peaking right now. I think we had the highest inflation print that we will see for this current cycle that was announced in November. Year over year, consumer price inflation 6.8%. Producer price inflation close to double digits done again. That is the peak rate of change in inflation. Didn't say inflation was peaking. I said in rate of change terms. So think of consumer price inflation going from 6.8% to maybe 4% in the first half of 2022. But is that enough? Think about this. If you have inflation, if I'm correct, and inflation contracts from 6.8% to 4% year over year inflation, that's 2 times faster than the Fed's own ridiculous 2% target. And if inflation's twice as high as the Fed's ridiculous target, it's untenable to believe that they can continue to keep interest rates at 0 and continue to print money and expand the base money supply, which, by the way, has increased by $4.8 trillion in the last 2 years.
What will happen in the fiscal cliff of the second quarter is combined with the Fed reducing the balance sheet with $1 trillion to stop inflation.
Okay, so the Fed is going to continue so it's the opposite of the Fed's put. We used to have a Fed put which said, well, the economy is going to improve, or we're going to keep printing money until it improves. So, I'm going to flood the Wall Street with money, which will help the stock market.
So don't worry if you're afraid the market's going to fall. Just go ahead and buy stocks. We got your back.
Just buy stocks. We're going to buy, we're going to underwrite corporate bonds, junk bonds. We're going to underwrite municipal bonds. We're going to underwrite all kinds of debt. We will never let the stock market fall. And we're going to keep doing that until the economy improves so much that it doesn't need our help. That was the Fed put. But now it's the opposite. I mean, either the economy is going to poop the bed and inflation is going to fall rapidly, which would only be a consequence, a derivative of the economy falling off the cliff, or the Fed's going to NQE and drain its balance sheet and tighten interest rates until it does. That's the opposite of a Fed put. And you'll never hear anybody admit to that, because if you're a wirehouse on Wall Street, I have a lot of, I've been in this business for 31 years. And I know I look like I haven't been in there that long. Let me tell you something, Dunnigan. You can't go on TV if you're, JP Morgan and say, hey, we're in for a really difficult time. We have a fiscal cliff and a monetary cliff on top of, various COVID mutations, and we're going to have a rapid slowdown in the economy next year. So I'm recommending my retirement funds to raise 50% cash and to go short the market for the first few months of 2022. Well, it's illegal for them. They'll get a call from their compliance department and say, excuse me, you're charging fees on 30% cash, and that's illegal. In a retirement account, you can't short stocks in it. It's illegal. Can't do it. So they have a very vested interest in coming up with a permanent bull market. It never ends. So that's how their bonuses are predicated. So you'll never hear this from Wall Street, Main Street. I call it the deep state of Wall Street. But I can tell you that I am very cautious going into Q1 of next year, and especially Q2 of next year, where the year-over-year change in inflation will plunge. Year-over-year growth will plunge. I'll give you one statistic for why I say that. So in 2021, earnings growth in the S&P 500 was 45%. It's going to be about 45%, Dunnigan. That's amazing. How did we get 45% earnings growth? You printed $4.8 trillion, and the Treasury handed out $6 trillion, which was the equivalent of 50,000 on average. I didn't get any money. But the average American family, if you divide American families by 6 trillion, you get $50,000 over the last 2 years for every American family. That goes to zero. And Joe Manchin, by the way, just killed the child income tax credit, which was $300 per month per child on average. That's not going to happen anymore because the Build Back Better program has been killed, at least until maybe Q2 of next year. So the fiscal cliff is the biggest toboggan ride we've ever seen, on top of a monetary cliff like we've never seen before. And on top of earnings growth that's already based, just on base effects, already going to fall from 45% to mid-single digits at best. So if you're like me and you have the ability to go long and short and raise cash, ride the four horsemen of the economic apocalypse, you very well might have to do that in the first half of 2022. And I'll rely on the model that I created, which myopically looks at credit markets, to let me know when it's time to get net short the portfolio. Right now, I will tell you, the portfolio has 35% hedges in it. So it's not net short, but we are cautiously pessimistic on the market next year. Then again, I'm not a Cassandra at heart. I'm unusually optimistic. I believe God works everything for those who believe in him, works for the good, for those who trust him. I really believe that. I'm a perennial optimist. But what we've concocted here in the stock market is the greatest asset bubble we've ever seen. And that includes real estate, fixed income across the spectrum, and equities. Never been more inflated. And it's a triumvirate of asset bubbles. In my opinion, Dunnigan, the sooner this breaks, the better it's going to be for everybody. Because the longer it goes on, the more devastating the plunge will be. So right now we might be looking like 89 Japan, or 2000 Nasdaq, and that's good news. If it keeps going on like this, we could be looking at either the most devastating depression we've ever seen or hyperinflation. That's the truth.
What point in your inflation, deflation, et cetera model do precious metals start to play a more significant role?
Okay, so I sold all of my gold in August of 2020. That's on the record. Everybody knows about it. On your program, talked about it. I then took a 6% position in precious metals a few months ago, which has not worked out for our portfolio at all. Gold is down a little bit, the physical part of it, and the miner that we have is down significantly, so it's not worked for us. Hasn't worked for anybody. Gold hasn't worked for anybody. Changing right now. I don't know if I'm making an announcement on your program, but I will very soon, in a matter of days or weeks at the most, start increasing my exposure to gold. And the reason is because I believe that real interest rates will fall in the early part of 22 because growth will be decelerating even more rapidly than inflation is decelerating. So you subtract nominal yields, which will be falling, from inflation, which will be falling, but not as quickly. And the fact that real interest rates will be falling in the context of the fact that people will soon, not right away, but soon reach the epiphany that the Federal Reserve will not be able to raise rates to, I think, then again, believe it or not, 2.5% is their terminal rate, which what they think is called their R star or fair value so it's a 50% real interest rate. So think about 2.5% minus their 2% inflation rate, assuming they get there. So now you have 50 basis point real rate on Fed funds, but the 10-year note's 1.5%. So I mean that's a pretty inverted yield curve. They'll never get there. That epiphany is reached sometime early next year, and then gold skyrocket. I mean, it's just going to rip higher unless we hit that liquidity crisis, and then everything gets dumped. So there's a very good possibility that gold will rip higher in the early part of 22 until we reach that liquidity crisis, which,
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really, really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.